Hello, everybody, and thank you so much for being here. My name is Lindsay Lee. I'm the Executive Director for Renewed North America. I'd like to welcome everybody to today's webinar on making U.S. sales tax less complicated with the founder of Yetter Tax, Diane Yetter. If you have any questions for Diane, you can go ahead and submit them through the presentation or at the end during the Q&A session. And if you could please use the chat function, that would be great. After the presentation, you're going to also have access to the recording and slides, which we will send you an email with the link once it's available. I also just sent a link in the chat where the access to her slides are, if you'd like to also view them there, even though she will be showing them on her screen. Please keep yourself on mute. And if you could possibly have your name and company in your box, that would be great, so we know who's asking questions. But anyways, yeah, let's get this started. I'd like to introduce you to our speaker, Diane Yetter. Yetter Tax is one of Renewed's partner members and is a sales tax consulting and sales tax technology service for local and global companies. Today's session will navigate the intricate landscape of sales tax nexus and compliance. So Diane, over to you.
Great. Thanks, Lindsay. And hi, everyone. I'm excited to be here with you. As Lindsay said, what we're going to talk about today is what do your companies need to be aware of when you're thinking about or trying to evaluate whether or not you have nexus, which is the term of art that tells us whether or not you have an obligation to collect and remit and file for U.S. sales taxes. So sales tax has been around in the US since the 1930s, and historically, all up until 2018, the determination as to whether or not you had that registration requirement was based on whether or not you had physical presence or physical nexus in the state. And that physical nexus is usually created by having some sort of physical people presence in the state or physical property presence in the state. And when we think about that, where we normally think of our initial thinking of employees are people, but it also can include independent contractors. And I know in your businesses, the use of 1099 contractors is something that is pretty prevalent. And so those activities conducted by those contractors can be considered that physical presence in a state. Now, that physical presence can be based on a permanent location. So if we're talking about employees, where do you have employees living? Where do you have employees working out of an office that you may have? So those as permanent, but then you also have transitory or temporary presence. So things like going to conferences and trade shows, if you are putting on those types of conferences or trade shows, or you are traveling and you are exhibiting at a conference or trade show. Or if you have employees, sales personnel that may be traveling and visiting customers, those could constitute physical presence in the state. And then your property, things like where do you have an office? Those are pretty permanent locations that you might have. You may have warehouses that are housing publications that you may be distributing or other types of materials. Or you may have temporary inventory that maybe you are bringing things to one of those conferences or trade shows and actually selling copies of books or something like that. Or if you are using third-party fulfillment contractors, those kind of fall into both those 1099 contractors, but you might also still own the inventory when it is sitting in those warehouses. So when we're talking about physical nexus, it goes back to when the state first enacted their sales tax and continues typically for as long as you have that physical presence in the state. And most states have what we call a 1 year or 12-month trailing nexus. So you would have it usually until about a year after you cease having that. So that is what we always looked at prior to 2018. In 2018, we had the U.S. Supreme Court decision, South Dakota v. Wayfair, come in, and that was decided on June 21st, so just about 6 years and a week ago. And it established an economic nexus threshold presence. And this you only look at if you do not have physical presence in the state. So the case did not eliminate physical presence. It simply added it as a secondary way that nexus can be created. And so if you do not have physical nexus, then you would look at this economic nexus. And it is looking at what is your economic level of activity in the state. And it is measured by either your dollars of sales into the state or the number of transactions into the state. Although we are seeing states start to drop that transaction count because it was pulling in a lot of people with fairly low revenue in the state. So when we look at what constitutes economic nexus, there's a number of different considerations that we have to look at. The first is, what is that threshold? So the most common threshold still today is $100,000 of sales or 200 transactions. But other variations that we have is we have the $100,000 only. We have a couple of states with a $250,000 threshold. We have a few with $500,000 thresholds. And then we have two states, New York and Connecticut, that say you have to reach both their dollar and transaction threshold. New York is $500,000 and 100 transactions, and Connecticut is $100,000 and 200 transactions. So that's the first thing, is you need to know, what is that threshold? The second thing that you have to know is, what types of sales do you count? So most of the states use gross sales, which means it's your total sales into the state, regardless of whether they are taxable or not. So those would be the gross sales. A retail threshold means that the only sales that you count, or rather what you get to exclude from counting, is if you sell for resale. So if you're selling to someone else that has given you a resale certificate because they are reselling your product, you get to exclude those when you are counting whether or not you meet that dollar or transaction threshold. And then the third type that we see with just a few states is a taxable, which means you only count the sales that are actually taxable in the state. And so if the item that you're selling is non-taxable, it doesn't count towards meeting that threshold. Now, when we talked about physical presence, I said you had nexus as of the date that you first started in the state. In the economic nexus, you actually have a measurement period, which is what period of time do you add up all of those dollars or transactions to determine whether or not you meet the threshold. And all of the states have a 12-month period. Most of them use a calendar year. However, some of them use a rolling 12 months, a rolling 4 quarters, or a set period. For example, Connecticut uses October 1 to September 30th. So they may have a different 12-month period. And then if you do exceed the threshold within the measurement date, then you need to know, how quickly do you have to register? So we still have a lot of states that say on the next transaction that you need to register, but then we have others that are giving you a grace period. It might be to the first of the next month, it might be a couple of months, or a couple of the states actually give you until the first of the calendar year. Or Connecticut says you don't have to register until October 1 after you cross that threshold in the October to September period. And Pennsylvania, if you cross in a prior calendar year, you don't have to register until April 1 of the next year. So that tells you, what do you need to look at, how do you measure it, and how quickly do you need to register. Now, when did all of these become effective? Every state in the U.S. plus Puerto Rico now imposes economic nexus. The first states, it was effective July 1 of 2018, after the case passed or came down June 21st of 18. New York technically said that it was effective June 21st of 18, but doesn't really enforce as of that date. we had states change their or enact it over a number of years, and Missouri was the final state that came in on January 1 of 2023. And I'll show you a link to a chart where you'll be able to see all those specific dates. Now, if you sell outside of the US, many countries, including Canada, the EU, the UK, Australia, and a number of others, impose similar provisions with an economic nexus, especially for digital goods sold to non-registrants, basically to individual consumers, not to businesses. So if you are conducting business outside of the US and you sell to individuals, there is a very strong likelihood that you could have a collection obligation in those countries. Unlike the US, these other countries, for the most part, have a transaction one obligation, meaning that you have to start collecting that tax on the very first transaction that you make into the country. So a bit more onerous than the US. However, most of those countries have a single tax rate, and you don't have to worry about all of the local taxes that we have here in the US. Now, the question I get asked very often is, do I have Nexus forever? And I mentioned with physical presence, typically there is going to be that 1 year after or 12 months after you cease having physical nexus. And we have a similar concept with economic nexus. So just as we have that measurement period, there is kind of what most of the states use is you look at the prior or the current year to see if you exceed the economic nexus. And if you do, then you have it through that current year and the next year usually. But if you were to drop and then you no longer exceed that in the measurement period, then you do have the ability, depending upon the state, to either cancel your registration or request being moved to inactive status. Now, there are pros and cons to canceling your registration. We typically don't advise it if you're just fluctuating a little bit, below the threshold. But because we did have states that have dropped their transaction threshold, if you were only crossing and being required to register because of exceeding the transaction threshold and you're nowhere near the dollar threshold, then that is certainly a state that we would recommend that you cancel. Now, I've given you a link for a chart on our website, which has all of these rules state by state. So you can see we've got the effective dates of all of them, what the threshold is, the measurement date, the includable sales, which is whether or not they are the gross sales like Arizona, taxable sales like Arkansas, or retail sales like Colorado. The other part that we have here is whether or not if you sell on a marketplace like Amazon or eBay or Etsy or something similar, whether or not the sales on that platform are going to be included or excluded in determining if you exceed the threshold. And then the last column we have here is how soon do you need to register? So you can see California, it's the day that you exceed it. Colorado gives you the first day of the month after the 90th day that you exceeded the $100,000. So you can see that they really vary in terms of how quickly you need to register. So that link in the slide will take you right to that. In terms of what are all the thresholds, this is the map that gives you those thresholds. You can see that we are now a little bit more predominant with the light purple, which is the $100,000 only. And that is really because of the recent change in Indiana, which changed their threshold, dropping the 200 transaction counts as of January 1 of 24. Louisiana dropped theirs August 1 of last year, South Dakota July 1 of last year, and Wyoming is due to drop theirs as of July 1 of this year, so next week. The dark purples are the $100,000 or 200 transactions. The light green, Alabama and Mississippi are the 250,000, and then the dark green, Texas and California are 500,000. The hashed marked ones are Connecticut and New York that I mentioned were they have an and transaction. So Connecticut is 100,000 and 200 transactions, and New York is 500,000 and 100 transactions. So a visual to help you with that. Now, one of the other things that is really critical in order to determine whether or not you have Nexus and also whether or not you have a collection responsibility is identifying what are the products that you are selling, products or services, and how are they classified. Now, unfortunately, states do not have a consistent classification, just as they do not have a consistent taxability as we look across any product that you might have. The first thing that you certainly have to make the determination is, are you doing something in physical print or are you delivering digitally? If you're delivering in physical print, there are different questions that you have to look at, such as how are you mailing it and filing frequency, and we'll go, or distribution frequency. We'll talk about those in just a moment. But if it is digital, then it gets into a lot of questions in terms of how is it being delivered? Is it downloaded? Is it streamed? Is it remotely accessed? And then also, what exactly is the format? Is it text? Is it audio? Is it video? And then if it is some sort of an audio or video, is it live like we're doing this today? Or is it on demand that the customer can watch it at their leisure? And that can make a difference, as well as even the content. Is it educational in nature? Are there certifications that you get with it, such as getting continuing education credit or something like that? So when we think about digital goods, one of the things that we look at is there is a group of states, 24 states, that make up what is called the Streamlined Sales Tax Project or organization. And these states have come together, and this has been in place for a little over, we just have our 25th anniversary. No, I think we had our 20th anniversary 2 years ago. So I think we're at 22 years. And their goal was actually the Wayfair outcome, which was the economic nexus, or a collection of tax not based on physical presence. But one of the things that they have done, and that is a tenet of their organization, is coming up with common definitions that all the states that are participating members must follow in their definitions. Now, it doesn't dictate how they have to tax it. It simply dictates how they have to define it. And that is so that there is consistent definitions across the states on any given thing. And so one of the definitions that or a group of definitions that they have defined, are digital goods. And so they have created these 3 definitions of what they call specified digital products. And so specified digital products means anything that is electronically transferred that meets the definition of a digital audio visual work, a digital audio work, or a digital book. And so you can see that the audio visual, basically think of it as a video, related images with sounds, digital audio, think of a podcast, a song, ringtones, and then digital books, things that we normally think of as books. So a Kindle book, for example. So those definitions help guide us as we're trying to determine, when we look at any company's products, do they fit within these different categories? Now, when we're talking about physical products, the types of things that can come into play are the frequency. So how often is it published? Is it delivered? Is it at least once a year? Is it daily? Is it at least X times a year? Different states vary. It needs to be at least 4 times a year, at least 2 times a year. We've got some states that the delivery method or the postage classification. So if it is delivered via USPS, it may be exempt, but if you send it via private carrier like UPS or FedEx, it might not qualify. Some of them, it depends on if it's first class, second class, third class. And then there are other states where whether or not you are selling a single issue of something or is it a subscription. So those are some of the things that we have to look at when we're looking at determining the taxability of a printed item. The next thing is trying to figure out what is the content. And with the businesses that all of you are in, one of the things that is really the challenge is states outside of those streamlined states, and even some of them within the streamlined states, they don't have a common explanation or a common classification for things that you sell. So it might be considered data service, data processing service, an information service. If it is using an application, which we all know if you're going to access something remotely online, you need some sort of an application to allow you to do that. But is it simply a reader like Adobe Reader, or is it a platform that you're logging into, the user is logging into, that allows them to search and maybe comment or do different sorts of activities to that content? So that is one of the most difficult things. We've worked with some businesses in your industries, and this can be the real challenge, because the other thing that we have is a lot of bundling where you may be including audio visual, you might have an information service, you might have a SaaS application that are all included as part of a subscription service. But as an example, Texas, which taxes a lot of digital processing and a lot of digital goods, says that they have a definition of data processing. And data processing is very broad in Texas's sense, including things like software as a service. So it says using a computer for word processing, data entry, production, compilation, storage, or manipulation is a taxable data processing service. Now, we like things to be, if they're going to be taxable in Texas, we like them to be classified as a data processing service or an information service, because both of those allow a 20% deduction from the tax base. So you're only paying tax on 80% of the base. If you're considered downloaded software or delivered software, you don't get that 20% reduction. The other definition that I've got up here on the screen is the information services. So that is the gathering or furnishing general or specialized news or other current information, including electronic data research or retrieval, and providing access to databases of such information. So a lot of publishers are going to fit into that category because of the information that you're sending. And it doesn't have to be just general news at all. The specialized news will get that. I don't have it as a slide, but to give you an example of a difference, the city of Chicago has a tax. We call it the personal property lease transaction tax that is imposed on all personal property, not just tangible personal property, that is not purchased, not sold. It is used. And in the city of Chicago, there is a tax on very similar definition of information services. However, it does not include anything that is proprietary. So something like a subscription to the New York Times or the Wall Street Journal is not going to be subject to that tax. And if you have all of your own writers, we did a letter ruling on this for a client, and you have all of your own writers as your own employees. So this is where using 1099s may make a difference. And you have proprietary copyright of all of the content, and you're not gathering public information and creating a centralized database for people to research, that is not subject to it. But having access to, I subscribe to a number of tax research databases, and because those are pulling information from public sources, such as court cases and statutes and regulations from the different states, that does not qualify for that proprietary information. They have a tiny bit of proprietary information in there, but the bulk of it is all public information simply pulled together in a centralized portal. So they are required to charge that Chicago tax and would clearly fall under this Texas Information Service. So this hopefully gives you a little bit of a taste of some of the complexity of trying to figure this out. Now, the next piece that we have to look at is, who is your customer? There are some differences in taxability depending upon if you are selling to a business and they are using whatever they're buying from you in their business, or are they an individual person and they are buying it for personal use. So most of the exemptions that we see apply if it is business use. However, Ohio has an exemption on, they tax a lot of these same sorts of things, similar to the definitions for Texas that we just looked at. However, if it is for personal use, then it is exempt. But we see Iowa, Maryland, New Jersey, and Washington are the primary states that have business use exemptions if you are selling to a commercial enterprise for use in their trade or business. So you can see that they're slightly different, and certain items, Maryland requires it to be licensed solely for commercial purposes and used in an enterprise computer system. So if it is an information service, more of a subscription, that might not, I don't think it's going to qualify all the time in Maryland, but if you are in Maryland and you are buying software and you're running it on an enterprise computer system that is running things in your business, then that very well may qualify as the exemption in Maryland. But knowing who your customer is going to be the kind of the last big key to doing that. Now, all of those things come into play to help us make that determination of nexus. So if you remember when I talked about economic nexus, we had those three categories of gross sales, retail sales, or taxable sales. Where those categorizations and customers and any exemptions that apply become most relevant is in the taxable states, but the retail states also, it could become relevant if you are selling to somebody for resale. So if you're trying to determine, do you need to be registered for sales tax? And if so, as of when? The first thing that you really need to do is make that determination of, first, do you have physical presence in a state, or is it only economic nexus? Once you make that determination, the second thing is to determine what is that start date. When did your presence actually start? Then going through and calculating the exposure, and I'm going to go through some of these in a little bit more detail. So if you just hired a new employee that's going to start July 1 in a state and you haven't had any other prior nexus, then your start date there is going to be July 1 of 2024. No exposure, no worries about that. But what if you've had an employee in the state for the last 20 years and what you sell is actually taxable? Well, now you may have some significant exposure. Or it's just economic nexus, but it's going back now in some of those states 5 to 6 years. So you want to go through and make that determination. If you sell business to business, we always ask and recommend that you communicate with your customers to see if they may have paid the tax. So anybody that buys anything, and this is really why economic nexus came into being, is although there is an obligation on the purchaser that if they buy something that is taxable and they did not pay tax on it when they bought it, they have an obligation to pay that tax directly to their state. Businesses, often, particularly larger ones, do take care of that obligation. Small businesses and individuals rarely do. And so if you are B2B with predominantly larger customers, as you're going through and making this determination, if you have any exposure, we always suggest that you talk to those customers to find out if they have paid the tax directly. If so, that will eliminate it from your back exposure. However, there are only a few situations where it would allow them to continue to pay that directly and you not have to collect the tax, but usually you would have that obligation now that you become registered to collect that tax. Depending upon how broad or how large that exposure is, you may want to take some corrective actions, and I'll go through those in a little bit more details. And then lastly, if you do determine that you need to be registered, the next thing is you need to make sure that you take those corrective actions to put a solution in place that will calculate your tax, charge the tax to your customers, collect that tax, and then prepare the returns and remit that tax and file those returns with the various different taxing jurisdictions. So let's talk a little bit about determining that registration start date. So this is really one of the key things to evaluate as you're trying to determine, do you have exposure? So as I talked about earlier, physical presence, what is that start date that you have a person or property in a state? If it's economic nexus, going through and making that determination using all of those different factors that we talked about to determine when did you actually start and have nexus. If you have had nexus back to 2018 when economic nexus came in, or earlier because of physical presence, then one of the things that you really want to look at is what is the size of the liability. Now, if you are strictly a digital goods publisher and you're selling into the state of California, California doesn't have tax on anything digital. So although it's a very large state and maybe you have exposure going back in time, you may have no actual liability. So that is an important thing to go through and do that calculation. It may be that it is Missouri. You're doing publishing, physical publishing in Missouri, economic nexus, but it's only since January 1 of 23. So you've only got a year and a half. That liability might not be that broad. But if you're in the state of Washington, their economic nexus has been in place since October of 2018. They're one of the early ones. They tax virtually everything digital. So there, and they have a fairly high tax rate. There you might have a significant liability to worry about. If you are not registered yet, and you are going through this process, I would tell you please do not jump the gun and start registering to start collecting the tax until you have made the evaluation as to whether or not you're going to take any corrective action. And the reason for that is many of the states, once you are registered, you no longer have the ability to participate in some of the settlement programs that are available. So let's talk about those. So what we call a voluntary disclosure agreement, or VDA, is the most common way that the states offer the ability for businesses to come forward and come into compliance with some sort of concessions being offered by the states. Now, some of the states have fairly beneficial concessions that they will make. A couple of the states will waive, all of the states pretty much will waive penalty as long as you haven't collected the tax. Some of the states, we've got a few that we've been able to get some interest abatement. And then if your look back goes back further than 3 or 4 years, all of the states have some period of time that they will actually take off some of those early periods. So most of the states, the look back is 3 to 4 years. If you have nexus, let's use the Washington example I just used, going back to October of 2018, the Washington look back is 4 years. We're almost 6 years since that date. So you'd be able to knock off a year and a half, year and 3/4 if you were to go in and pursue that voluntary disclosure agreement with the state of Washington. But if you're registered, you are usually precluded from that. So some of the things that we always look at is, what is the risk of discovery? There are some states that are being very aggressive in coming after people that might just register today. We have as I have down in the last bullet there, Arkansas, Arizona, Illinois, Maine, Massachusetts, and Wisconsin are being very aggressive that if you submit a sales tax registration saying I'm going to start collecting as of July 1 of 24, but then your liability, your sales amounts are pretty large, they look at it and they say, I think you should have been registered sometime in the past. And you will get a nasty gram from the state. Sometimes it's just, can you check if you should have been registered sooner? In other states, it actually Maine, it actually comes as an audit notice. So you end up getting caught with that. Now, those are the states that we've been seeing doing this for a number of years now. But because we're now at 4 or 5 years, 6 years since Economic Nexus came into play, we are seeing the states all starting to get a bit more aggressive on their audits. So one of the things that you want to think about is what is your risk of discovery and risk of look back? The other way for discovery is if you do business with any state or local governments, if you have them as your customers. There are states that require you to be registered, even if you don't have Nexus, in order to do business with them. And so if you are not registered and you have a contract or you are bidding on a contract with a government, just be aware that that could be something that could come back. We're starting to see states starting to really look at that a little bit more closely. Once you determine that you need to be registered, the next thing that you need to figure out is how are you going to calculate tax on your actual selling transactions? So some of the key questions that you need to ask to determine how are you going to do that is what is the system that you're selling out of? Some systems actually do not allow you to use an independent third party, what we call a bolt-on tax engine. You may have to do your tax calculation directly within that system, and it may actually not have all of the content, the taxability rules that you might need. If you have the ability to connect to a third-party tax engine, that's usually my recommendation, particularly in the industries that you all are in, because you have some of those complicated taxability rules and mapping where the classification may not be the same across all of the states. Determining which system works is going to be dependent upon what is the selling system that you're using. Some of the tax systems have very broad integration options in terms of what they have connections already built to work with, and others have a little bit more limited. What is your volume of transactions? Some of the systems charge based on the number of invoices that they process. Others charge based on your revenue. What geography do you need? Is it just the US or are you subject to some of these international taxes that I mentioned? And then there are those streamlined sales tax 24 member states. One of the other things that they have to provide to be part of the club, so to speak, is they have to provide free software to businesses that are strictly economic nexus. And so if that is your nexus profile in a lot of the streamlined states, there are currently 5 different vendors that participate and are certified to provide those free services. So if that is something that you qualify for in a number of the states, then you may want to focus more on the solutions that qualify for that. That's how you calculate the tax. The second piece is you have to be able to file those tax returns and remit the tax. And so you can do that either in-house, your own people can do that. You can outsource it, or many of the tax systems have either an integrated or a companion compliance solution that will prepare those tax returns and actually submit the returns and the payment. So you want to make sure that you have something lined up or start working on getting that solution in place so that you can be compliant going forward after you resolve any open issues that you might have. So this is actually a service that we offer. And for our renewed members, we're offering a discount code. So if this is something that you are concerned about, I would encourage you to sign up for our Wayfair risk analysis is what we call it, and then use that discount code to get $300 off. And what you'll do is you'll provide us all of your sales information going back to 2017 if you've been in business that long, as well as where do you have people and where do you have inventory. We do the analysis, and then you have a phone call with me to go over the results. So hopefully that has given you a little bit of an insight as to what are the things that you need to think about and look at in order to determine where you might have physical nexus or economic nexus. So Lindsay, that's what we've got.
Great. Thank you so much, Anne. We did get a message in the chat
Okay.
of a quick question. It's from Amanda. She did have to jump off right when she was sending
Okay.
it, but she's going to listen to the recording anyway. So she did say she apologized. She has to leave, but
Okay.
again, she'll listen to the recording. They are a UK company selling SaaS to US businesses.
Mhm.
Her question is around physical nexus and traveling activities. Could a one-off visit or a couple of visits from a salesperson from the UK trigger physical nexus?
That's a great question. So when we're talking about transitory or temporary physical nexus, the first thing that we have to look at is what is the nature of the activity that is being conducted in that temporary visit, and what is the duration and what is the frequency. So those are the three things that we usually look at. If it is a sales solicitation visit, we typically look at about 6 days in any given state in a year before that is going to really trigger nexus. Now, there are some states, Texas being one of them, that says 1 day in the state doing anything is going to create that physical nexus. But we feel like what the statutes say is you have to have substantial physical presence. And we don't think one visit, 1 day, ever or a year really is that substantial. And that's where we kind of internally use about 6 days. Now, if instead of it being a salesperson coming in to call on a prospective customer, you have somebody coming over to do training. Well, that training is now a service, whether you bill for it or not, it's included in the subscription. That typically is at a much lower threshold. So we typically say if you come over and you're doing training and you're going to have ongoing subscriptions or sales going into that same state, there you're probably looking at just a couple of days. And then the other category that I'll talk about are trade shows. So if you are coming to attend or exhibit at a conference and you are not the organizer, there are a number of states that have a set number of days, as long as you are not physically selling, you didn't bring inventory, you're not accepting orders, you're not accepting payment. And those range from 3 days up to, I think the highest state is 15 days in a year that you can do with it to do that. Not every state has that rule. Not every state has addressed it, but that is what you can look at. Now, if you are the organizer, you're actually putting on the event, kind of like the renewed event that just happened. That would create physical presence, because there you are actually setting up a temporary office, so to speak. You're running that event. And so there you are probably going to have a greater presence and likelihood of nexus for that. But great question.
No, that's great. Thanks, Diane. That was interesting for me. Does anybody else have any questions to pop in the chat? I think you answered so many good questions. I don't think anyone has too many questions. You covered everything.
I know
So
it can be
that's great.
overwhelming.
And well, I think that's all we have. Is there anything else, Diane?
I think, the only other thing that I would probably, suggest, that people look at is really be aware of the products and services that you're selling, and being cognizant of how you write your contracts, how you write your license agreements, how you promote it, how you list it on invoicing, how you describe it on your promotional material on your website, and make sure they are consistent. What we find is a lot of companies in this industry have a tendency to be a little bit lax on what terminology they use, and even pulling some like boilerplate contract language. If you're doing a software as a service, a SaaS application, the customer should not be downloading anything. They should not have anything that they need to return if they cease their license. You're just going to cut off their access. So be careful about using a software license agreement as your default template for a license agreement for access to a database, for example. We've had to fight some pretty big battles with some states, with companies in this industry that have used those wrong terminology. And so what the states are going to say is, I'm going to look at your contract. And if your contract says software, your contract says it's downloaded, your contract says they have to return it when they cease their license, then I'm going to say that you have downloaded software, which is taxed in many more states than remotely accessed software or SaaS. And so that's really important to make sure that you are consistent. And then the second thing is bundling. I know that bundling is a big, big thing that happens in this industry, where you are providing a package of things that all are available. So it may be a printed item, it may be a digital newsletter subscription, it might be a physical book or some sort of promotional item that is sent when they subscribe. There might be an application. It might include access to your conferences and different things like that. You bundle all those together, and what the states typically have as a rule is, if any one of those items in the bundle is taxable, you potentially risk taxing the entire bundle. So if you have a small amount of physical goods that go in with this bundle, you could potentially have to tax the whole thing. What the streamlined states have set up is a 10% threshold. So if the value of those taxable goods exceed 10% of the entire bundle, then the entire bundle becomes taxable, even if 90% of it is exempt. So looking at how you are creating your subscription packages, just be aware that that is a risk that you have, and it may be unavoidable. It may be completely unavoidable, but looking at how you put those things together could have a real impact on your tax consequences.
No, thank you, Diane. That was great. I really appreciate it. Thank
Sure,
you.
sure.
I think we have,
And
oh, go ahead.
we're happy to help if anybody's interested in just finding out more information. Our website has a lot of resources on it, white papers. We have different charts on different things. We track legislation. We have tips that we write out there. So I would encourage you to check out our website at salestaxinstitute.com, and then also if you're interested in this and want to get more information, you can sign up to be added to our newsletter list.
Awesome. Great. Well, thank you so much. And
Thank you.
everyone, go ahead and expect to see, we'll try and get that recording with all the links to you guys tomorrow. The latest will be Monday, but I hope everyone has a good rest of your afternoon, day, whatever time zone you're in. Some of you are night. And thanks again, Diane. We really appreciate it.
Thank you.
We got a bunch of thank yous in the chat, so I know
Yep,
everyone
I see
appreciates
that.
it.
All right.
Awesome. All right. Have a good one, everybody.
Thank
Bye.
you. Bye-bye.